In today's episode, we're talking about year-end planning and tax planning, opportunities and strategies to look into before the end of this year. Are you taking advantage of everything that you can from a financial standpoint that you need to by the end of the year? Also, I find nobody likes paying the IRS, so we're going to talk about strategies to look into to help put yourself in the best tax position possible this year, next year, and all the future years of your life.
Welcome to the Your Life, Your Money podcast with Scott Sierens, teaching you how to thrive in life, wealth, and retirement.
Welcome into the Retirement Show, all about your life, your money, and your taxes. I'm your host, Scott Sierens, and my goal is to help you thrive in life, wealth, and retirement. And my first question to you today, you might think this is kind of way off, but you'll see, I'll connect it, is does anybody out there like a nice, lush, thick, green yard, green lawn, just like I do? Well, maybe so, maybe not. But either way, here's what I've learned it takes to create that nice, thick, lush, green lawn. It takes a lot of work throughout the year. And if I really want it to look even better next year, and the year after that, and the year after that, well, what I've found is that it takes a lot of work also at the end of this year to be able to make that happen. I need to aerate the lawn. I need to overseed the lawn. I need to water that new seed to help it get growing. And then I've got to put a winterizer fertilizer on that lawn before winter comes, all to get it to look really nice next year and then keep it nice, thick, and lush for next year and the future years beyond that. So why do I bring that up? What's the connection to today? Well, the same holds true for your taxes. If you want to help your taxes look better next year and the following year and the year after that, or just this year, then all those following years. Well, what does that mean? It means that you need to do some tax planning at the end of the year. I realize it still all takes work throughout the year, but a big part of that is that you want to, just like the lawn, do all of that work at the end of the year to make that lawn look really nice the next year. If you want to help make your taxes look better, not only this year, but next year and the following year after that, it takes work at the end of the year, and that's called tax planning. So that's why I'm talking about it today. We're going to talk about tax planning. We're going to talk about year-end planning. And you might be thinking, well, Scott, it's only October. We're not even to December yet. Like, is this like the stores putting out the Christmas decorations way too early? No, actually it's not necessarily. You see, we start meeting with all of our clients in October because by the time you talk about the strategies, and then you might need to do some planning around those strategies, well, guess what? Next thing you know, it's the end of November. And a lot of institutions will require you to have all of the paperwork, form work, everything done by that first week of December. Otherwise, they're not going to implement the strategies for you. And a lot of these strategies have to be done by the end of the year. So why not just do them now? Why not do it now, be done with it, have your tax planning done, your strategies done, so that way you can cruise into the end of the year knowing that you've got everything taken care of. Now, another thing you might be thinking of is, well, wait a second, I have a tax preparer and they help me out in, March, April to make sure all my taxes are ready. So I think I've done my taxes this year. Well, let me just explain tax preparation versus tax planning. And I'll tell you what, I've got a great tax preparer as well, person that helps me prepare my taxes. And what does that mean? Well, I hand them all of our information from an income standpoint for what happened last year, what happened in history, right? So they're more of a historian, and they're taking a look at what happened last year, and then based on that, they're providing us, here's how much you owe in taxes to the IRS. We've prepared your taxes, and here's how much you owe. And they'll take a look at it and say, hey, here's some extra, deductions that I think that you might be able to use in your situation. But again, here's what happened in history, and here's how much you owe. Well, history is great, but there's nothing you can do to change it because it's already done. You can just prepare taxes based on it. Our goal with our clients, and something that you need to help, that you want to focus on, is tax planning, focusing on the future, focusing on how can you do better this year before the year ends. And just like creating that nice, lush, thick, green lawn year after year, what can you do this year to help you for next year? What can you do this year to help you for 5 years from now, to help you for 10 years from now? And that takes planning. And the other big difference is tax preparation is primarily focused on the income that you have coming in and paying taxes on that. Tax planning is going to take a look at more than just your income. It's going to take a look at where do you have your money saved? Is it in IRAs and 401ks? Is it in a brokerage account? Is it in real estate? Is it in Roth IRAs? Where is your net worth? What types of tax accounts are those in? Also, it's going to take a look at your income. It's going to take a look at where you're saving money to. Is it to the 401k? Is it to the Roth 401k? Tax planning is going to help you look at that future. Now, we're going to get into the year-end planning and tax planning checklist, but I just wanted to kind of give you that overview of tax preparation versus tax planning. And a key part of tax planning is putting together a tax projection. So what is a tax projection? Well, tax projection is going to look at, one, what you need for money. It's going to look at income that you have coming in now. It's going to look at income that you have coming in next year. And it's going to look at income that you have coming in through the rest of your life. So it's looking at taxable income throughout your life. And what does that do? Does it stay the same over life? Does it go up? Does it go down? And see, a lot of times people forget about what I'll call the retirement tax surprise. That retirement tax surprise is going to come from your IRAs and 401ks. That in your 70s, you're going to have to start taking required minimum distribution or forced income from your retirement accounts. And as you've heard on this show many of times, all the money that's going to come out of your IRAs, 401ks, 403bs, 457s, none of that money has been taxed yet. So every dollar that comes out, you're going to have to pay ordinary income tax on. So we have to take a look at in your 70s and 80s when you're taking this forced income, and then add on top of that Social Security, and add on top of that maybe you've got a pension coming in, and add on top of that maybe you've got rental income coming in. We're going to look at all of that taxable income. Where does that put you in your future versus where you're at today? That's what a tax projection is. And then we can utilize that to help make some decisions on our year-end planning and tax planning checklist here that we're going to talk about. So that's what a tax projection is. That's the difference between tax preparation and tax planning. Hopefully you can start to see if you want that really nice lawn next year and the year after and the year after that, you got to do some work today. You have to do some work before the end of the year. And the reason for that is because for some of this work, there's a deadline. Just like you need to put that fertilizer down before that winter storm comes, we got to get some of this tax planning done before the end of the year, before some of those IRS deadlines and guidelines. So with that, what I wanted to do today was go through some of the different areas here on our year-end planning items. Some of the things we'll talk about are tax planning items, and then some other things that we'll talk about are just opportunities and strategies to help you maximize your situation. Some of the things we'll talk about today will be more basic, and then some will be more in depth. Some will be for people that are working, some will be for those that are retired. Some will be based on any income that you have coming in, and some for those that have some high income coming in. So hopefully you'll see today our goal is just to help everyone put themselves in a better position for their future. All right, so let's start by talking about, we're not going to go through the entire checklist today, but I want to hit the main points here that I really think that are going to help you in your future. So let's start by talking about the first area here. And the first area, I call it, is maximizing your retirement planning accounts. What can you do to help maximize your retirement planning accounts? So in this first area, I've got 6 parts. Part 1, are you funding your company-sponsored retirement plans? And are you maximizing those company-sponsored retirement plans? So are you putting money into your 401k? Are you putting money into your Roth 401k? Some of this is year-end planning, right? Are you getting the company match? So if your company says that they'll match 100% up to 5%, have you been putting in 5%? Or can you go put in more so you'll get the 5% free money that your company is going to match for you? The other thing, so from a tax planning standpoint, just keeping on this first part here, company-sponsored retirement plans, if you need a tax deduction, so let's just say you've done your tax projection, your taxes. So for all of our clients, we're going to do we do a tax projection each and every year, projecting out that taxable income throughout their life. Now, if your taxable income and taxes will be higher in the future than where they're at today, then maybe you need to pay tax today and put money into that Roth 401k. Get that tax-free growth. Maybe you're looking for some tax deductions. Well, that's using the 401k, the traditional 401k, or 403b, or 457, where you get that tax deduction today. Are you maximizing out your company-sponsored retirement plan? So the maximum limits that you can put in, a lot of times at the end of the year, we review with clients that are trying to actually get the max that they can put in. Your company won't necessarily help you do that. So you might have to kind of take a look at how much you've put in and then up your percentage a little bit so you get the maximum into that account. This leads me all to part number 2, and I started talking about it a little bit, but is optimizing the blend between traditional 401ks and Roth 401ks. So this is really looking at your tax projection. If you feel like your taxable income and your taxes will be higher in your future than where you're at today, well, then maybe you want to pay tax today, put that money into that Roth 401k and get it growing tax-free. But if you feel your taxes will be lower in the future than where they're at today, well, then you don't want to pay tax today. Well, then use that traditional 401k, get the tax deduction, push those taxes off into your future where they're going to be lower. So have you looked at your traditional 401k, Roth 401k? Do you have the right mix? Are you putting into the right one to help out your future? I'll give you one quick story here of kind of a blend actually between the two. So we've got one client where they're really teeter-tottering on different tax brackets. And so what we do in their scenario is they're putting into their Roth 401k throughout the year, but then as they get bonuses and we see other things happening, if it's going to start putting them into a new tax bracket, then they switch over to their traditional 401k, so that way for the remainder of that year, they're getting tax deductions on their money. And so it's kind of getting them up to a tax bracket line, but not jumping over into a new higher tax bracket. So that was part 2, optimizing your 401k, Roth 401k brokerage mix. Part number 3 here. Maybe you're maxing out your company-sponsored retirement plans and you're still looking for some areas to get some tax opportunities, to get some retirement savings opportunities. Well, then you can put money into your IRAs or your Roth IRAs. Are you funding these types of accounts? Maybe you don't have a company-sponsored retirement plan. Well, if not, then are you putting money into your IRA and Roth IRA? Because there's tax opportunities to each of these accounts. The IRA, you get that tax deduction today. Money grows tax deferred, pay tax on it later. The Roth IRA, just like the Roth 401k, pay tax today, grows tax-free, withdrawals tax-free. There's also an opportunity that I see a lot of people missing out on. For example, when meeting with a lot of new people, when they come in, they sit down and we go through their overall financial picture, they might have $50,000 sitting in their savings account or $75,000 or $100,000 sitting in their savings account. And I said, great. And what have you done this year and they're still working, so they have employment income coming in. I said, what have you done this year to fund your IRAs or Roth IRAs? And they kind of feel like, oh, well, we just don't have the cash flow to do it. And you know what? We've put into our company-sponsored retirement plans. And so then we kind of look at it and say, okay, this $50,000, and guess what? Now if you're using an online savings account, it's actually generating interest. I said, you're paying interest. You're paying tax on the interest on this $50,000. That tax is at your ordinary income tax rate. What would you think about getting that interest tax-free? And I'm thinking right now, you're probably thinking, well, yeah, I'd take that interest tax-free too. Well, guess what? All that is shifting that savings account money into the Roth. That's it. Shift it over. Now it grows tax-free. You get that interest tax-free, withdrawals tax-free as well. But see, it's just opportunistic thinking like that can really help your taxes each and every year. And so now just remember, to fund an IRA, Roth IRA, you have to have wage income or W-2 type income coming in. And there are income limits of, when you're able to make contributions, or you might get phased out of making contributions into those. But those are opportunities, and those are opportunities that you need to be looking into by the end of this year. Part 4 here is almost the same as part 3. Maybe one of you is retired and one is still working. Well, part 4 then is, should you be contributing to a spousal IRA or spousal Roth IRA? Same thing. I find, again, people sitting with money in their savings accounts, and guess what? They're not taking opportunities to get that money tax deferred or tax free, because they thought the one spouse was retired, so they couldn't contribute anymore. But the other spouse, as long as the other spouse has income coming in, guess what? You can use it. All right, part 5 of this maximizing retirement planning accounts. Part 5 is, are you utilizing your health savings account? Now, I'm not going to say this is right for everyone. It depends on your health situation and doctor's bills and medical bills throughout the year. But a lot of people don't realize that they might have a high deductible health plan available to them with a health savings account. This is both year-end planning and tax planning all in one, because from a tax strategy standpoint, if you put money into a health savings account, you get a tax deduction. And that tax deduction is in addition to your standard deduction. It's in addition to any itemized deductions. So it's great, right? You're getting actual tax deduction for putting this money in. Grows tax-free. Use it for qualified medical expenses. You can use it tax-free as well. I'll give you a quick story on this one. Meeting with a couple. They didn't realize that they had the high deductible health plan available to them. After we went through the comparisons, we found that, based on their health situation, it'd be okay to switch to the high deductible health plan. And then they had a high income coming in. This was another way for them to get a tax deduction on their high income that was coming in. Plus, they're going to use this now to save into for probably 5 to 10 years. And now they'll have tax-free money to be able to use to spend on their health bills, on their Medicare, on doctor's copays. Sometimes you can use it to pay for long-term care. So there's a lot of benefits, and you can use it all tax-free, right? Tax-free. So there's a lot of benefits to be able to use this health savings account. Okay, sticking with our first area here, moving on to part 6. Part 6 is if you're an independent contractor or a small business, there are accounts available to you as well. Accounts that can help you reduce your taxes. Accounts that can help you save and grow your money tax-free. This would be the SEP IRA, the SEP Roth IRA. You could use a solo 401k or a solo Roth. There are accounts available to you. I want to let you know that to help you from a tax planning standpoint. And then you can use these accounts to save money into to, again, help future years of your life, keeping more of that hard-earned retirement savings in your pocket versus giving it to the IRS. Now, before I move into the other parts here, one thing that I wanted to talk to you about is to let you know, listen in over the next 3 weeks. I realize that I'm just going through these parts, fairly quickly today, but guess what? Over the next 3 weeks, we're going to dive into the listener mailbag, but specifically to questions revolving around tax. And so it's going to help you take the strategies that we're talking about today, take some of the things that we're talking about today, and then how to help apply them to potential real-life scenarios, how you can then potentially utilize them in real-life scenarios. So listen in over the next 3 weeks. We're going to be answering some great questions all around tax. Okay, so that wraps up the first area there, maximizing your retirement planning accounts. Let's move into the second area of year-end planning and tax strategies. Now, our second area is Roth conversions. Should you be doing Roth conversions? I don't know your situation, and you want to have a qualified tax professional and a qualified financial professional look at your specific situation. But let's just say we did a tax projection, and today you're in the 12% bracket, and in the future, you're in the 22% bracket. Today's the 12% bracket, future's 22% bracket. Which would you rather pay on your money? 12%, 22%. No brainer, right? You'd rather pay 12%. Well, this is what Roth conversions is all about. Paying tax today at a known rate, getting the money into your Roth account, and then letting it grow tax-free. And then you can take that money out tax-free as well. So if you converted $50,000, that $50,000 grew to $150,000. Well, now it's $100,000 of growth. Guess what? The $50,000 that you converted over, the $100,000 of growth, all $150,000 comes out to you tax-free. And you know what? Again, if that's your situation, you paid less tax on that money to be able to do so. Now, there's also times where it turns out the opposite. People will be in lower tax brackets in their future than where they're at today, so they may not want to do a Roth conversion. Again, Roth conversion is taking monies from those IRAs, 401ks, those accounts that you're going to be forced to take money from in your future, pay tax today, get it growing tax-free. Another thing that you really need to think about when it comes to the Roth conversions here is that the Tax Cuts and Jobs Act, passed in 2017, scheduled to expire in 2025. So the end of 2025, if Congress lets the Tax Cuts and Jobs Act expire, again, it's expired. It's not like, oh, hey, we need to renew this. It's not like other laws where it just keeps going. This is scheduled to expire. And if it expires, tax rates will go up. For instance, the 12% bracket now used to be 15%. 22% used to be 25%. So 12 would go to 15, 22 to 25, 24 to 28, so on and so forth. So that's another reason to look at your situation. Even if you think that you'll be at the same taxable income throughout your life, well, guess what? At 2025, if they let that expire, you won't be at the same tax rates. You could be at the same taxable income, but your tax rates will go up. So that could be another reason why you want to look to do a Roth conversion today, pay that tax, known rate, before the taxes go up in the future. So what's it require for a Roth conversion? Well, you want to look at your tax projection to see where taxable income is. You're going to have to kind of think about tax rates. Where do you think taxes are going in the future? And think about the Tax Cuts and Jobs Act expiring. So this is one that is a tax planning strategy that you need to take a look at before the end of the year. This has a December 31st deadline to it. And again, a lot of those institutions will make you have it done by December 1st. Okay, part C of our tax planning, year-end planning strategies to take a look at is charitable gifting and planning. If you are giving to charity throughout the year, you see, it used to be that, well, first off, if you're giving to charity throughout the year, you know what? Thank you for doing a good deed for others. And that is the main part of giving to charity, is doing and helping others. Now, the IRS also made another part to giving to charities, meaning you can get a tax deduction for being able to do so. And it used to be that you'd give to charity, and based on how much you gave, most likely you'd be able to itemize your taxes and get a deduction for giving to charity. However, the Tax Cuts and Jobs Act also changed that, right? So it increased the standard deduction. So a lot of times right now, people give to charity, but they're not able to itemize their charitable giving or get a deduction for it. However, there's still some opportunities available to you out there. So if you are giving to charity, if you're over age 70 and a half, you should really look into the qualified charitable distributions. That's something that we do with a lot of our clients, is giving directly to their charity from their IRA, so it doesn't count towards money that they took out of their IRA. They're not getting taxed on that money then that's coming out of their IRA, because it's going straight to the charity. Now, again, you have to be age 70 and a half to be able to utilize that one. There's opportunities, strategies available, though, still for those that are under age 70 and a half that are giving to charity to get the deduction for what they're giving to charity. For instance, that's called a donor advised fund. And I'm not going to go into the details. Maybe I'll have to look. Maybe one of the questions is about that, where we'll go into some details about the donor advised fund. But just if you're knowing this, if you're giving to charity, hey, talk to your qualified financial professional, talk to us, talk to your tax professional. Should I be doing a donor advised fund? Maybe you've got money in a brokerage account. When I say money, investments in a brokerage account. Maybe you've been holding a single stock that has appreciated year after year after year. Well, you can take that appreciated stock, donate that to charity. That will help your tax situation as well. So lots of different ways potentially to get a tax deduction for giving to charity. So that's area C that we're going to talk about, or that we talked about. All right. Next, moving on here in our year-end planning, tax planning checklist. Area D that I want to talk about is, have you done a withholding review? I was just looking at somebody's taxes yesterday, actually, and I saw that they got a refund of $5,000. Now, they probably thought they hit the lottery when they got that refund. It probably felt so good, right? But actually, it was a free $5,000 loan that they gave to the IRS throughout the year of their taxes. Now, I don't know about you, but I'm not about giving free loans to the IRS. They already take enough in tax dollars. They don't need a free loan from any of us. So are you reviewing how much you're withholding from your paycheck, from your Social Security, from your IRAs, from your Roth? Well, you don't need to withhold from your Roth, but from your IRAs. Are you reviewing this, and have you paid in enough at the end of the year, or have you overpaid? And if you've overpaid, what updates can you do so next year you're not giving the government a free loan? The other thing that I said here is, have you paid in enough? And let me give you a quick story on that. I have a client at the end of the year. Their company gave them a nice big bonus. They're like, woohoo, got this bonus, it's great. What the company failed to do was update the taxes on that bonus. And so here's the deal. This bonus check felt awesome to this client, but we did the tax projection at the end of the year. We looked at what they would owe the IRS, and then we looked at how much they had withheld through the year. And guess what? They hadn't withheld enough. The company hadn't withheld enough from that bonus check. And so they weren't going to get money back. Guess what? They were actually in for a really big surprise of how much they were going to owe the IRS because of that bonus check. So doing the withholding review to make sure that you've paid in enough. Because the other thing is if you haven't paid enough, and you're not meeting the safe harbor rules, you can actually get penalized for underpaying the IRS. So we don't want to give them a free loan. We don't want to pay their penalties. We want to just make sure that you've paid in enough. So with doing a withholding review is really important as well. Now, a few that are more in depth here, and I'm just going to talk about things to look at. You can do this review on your own or talk to your financial professional about it. Are you looking at losses and gains, and can you harvest any losses? Can you harvest any gains by the end of the year? Maybe you took losses last year when the market was down. So do you have any, or in previous years when the market was down? So do you have any losses that are carrying forward? And if so, can you use those losses to offset any gains that you have? This is being really strategic in your non-retirement investment accounts, about investments and about saving on taxes. So that's that one. We'll kind of just leave it as that. Tax loss and gain harvesting, something that you want to take a look at by the end of the year. Our last few here, one is, let's just say you have a lot of medical expenses throughout the year and you're paying for long-term care insurance. So you've got long-term care costs, or you've got long-term care premiums, and it could be one or the other. But there are potential deductions out there if you have a lot of medical expenses. So if you're someone who is going through some tough times when it comes to health, and you've got a lot of medical expenses, prescription drug expenses, doctor's bills, you name it, keep track of all of those, or have a good idea. Ask your tax professional, hey, where would I have to be? What range of medical expenses would I have to be around to actually get a deduction on my taxes? Have them tell you, have your tax preparer tell you, so then that way next year you can keep track of all those medical expenses. Because if you feel like you're at that amount or over, there might be some deductions available to you from a health and medical standpoint. Let's just say you're a high income employee, or you're a high income manager, or you're a high income person at your company. Some companies offer income deferral plans. And if so, it might be something that you want to take a look at to help take some of your income off the plate today and defer it to future years where you might be in a lower taxable bracket. So something to think about there. Does your employer offer some income deferral plans? If so, might be something you look at. That's something you really want to marry up with your tax projection. And then the last part here is I want to dive into some year-end planning items to make sure you've taken care of these. What those items are is required minimum distributions. So if you are of the age where you've got to take those RMDs, December 31st is your deadline to have those taken out of your account by. Make sure you're doing it because, as you know, if you fail to do that, you could have a penalty. And again, who wants to pay a penalty to the IRS? So instead of paying those penalties, make sure you've taken your required minimum distributions. You might think, well, wait a second, Scott, I'm not in my 70s. Do I have to take one? You actually might. And here's how. Let's say you've inherited an IRA from a parent, from a cousin, from an aunt or an uncle or a friend, but you have in your account what's called a beneficiary IRA. Guess what? You might have to be taking required minimum distributions from that account as well. December 31st is the deadline. If you fail to do so, then you could be looking at penalties. So whether you have an IRA and you're in your 70s, or if you have a beneficiary IRA, make sure that you're taking those required minimum distributions by the end of the year. All right. There is more here on our retirement year-end planning, tax planning checklist. But I think just that today, hopefully as you're going through, maybe you're taking some notes on, am I doing this? Should I look into this? And you're finding as we're going through ones that might apply to you, hopefully you're taking notes to make sure that you're taking a look into those before the end of the year. And when I say before the end of the year, before December 1st, because a lot of times if you wait past that, you're not going to get the strategy done. You're not going to be able to get things done that you want to get done. So want to take a look at those. The other thing, just before we end here, as I mentioned earlier, over the next 3 weeks, what we're going to do is we're going to be opening up that listener mailbag and just specifically answering questions around year-end planning, around tax planning and tax strategies. So that way you can take information that we're talking about today and putting it into, I'll say, real life like situations. And hopefully then that will help you take this information today and take those questions and really understand how to put yourself, again, in that better position. Take that lawn that you've been working so hard on, right? That you've worked hard for, you've saved up, you've worked on it each and every year. Now, how do we take that nice, lush, green, thick lawn and make it even better next year and make it even better the year after that and better the year after that? So listen in over the next 3 weeks as we're going to have a lot of great questions that we're going to be answering around taxes, around tax planning, and around year-end planning. I hope that you enjoyed today's show. If you found it to be of value and benefit, subscribe on your favorite podcast player so that way you'll get notified when we come out with next week's episode all around tax planning type questions. Hey, I look forward to our next conversation, to helping you enjoy life today and being financially confident about your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.